This is FinTech Insider News. This week, UK AI startups accounted for a record 30% of all UK venture capital funding, according to HSBC Innovation Banking's latest report. Santander bank deal could mean the TSB name disappears from the UK high street, and Monzo was hit with a £21 million fine for AML failings. We'll be discussing all of this and more on today's news show, so don't go anywhere.
Introducing the new Volvo XC90 with 7-seat versatility, Google built-in, and advanced safety features for all your precious cargo. The new Volvo XC90, designed for life. Visit volvocars.com/US to learn more.
9 años pidiendo el snack wrap. Aquí tienes tu snack wrap. ¿Tú quieres un snack wrap? Toma tu snack wrap. ¿Tú también? Toma un snack wrap. Snack wrap, snack wrap, snack wrap. Volvió el snack wrap. Para pa pa pa.
Hello and welcome to episode 979 of FinTech Insider. My name's Laura Watkins, Director of Media and Marketing here at 11FS. Thousands have been around the green tennis courts in Wimbledon this week to watch some of tennis's finest stars fight it out to win the coveted Grand Slam title. However, while some of us might be chasing the ball, the rest of us are chasing down the best news stories in fintech this week. And helping us serve up the very best of those is our panel. And let's find out who's holding court. First up, we have a FinTech Insider return for Tom Easterby, Head of FinTech at HSBC Innovation Banking, who I also know went to Wimbledon last week, to continue this metaphor. Welcome to the show. How are you doing? Can you tell us a little bit more about yourself and your role?
Yeah, thanks, Laura. It's lovely to be back. Thank you for having me. So my name's Tom. I head up the FinTech team at HSBC Innovation Banking. What does that mean? At HSBC Innovation Banking, we provide banking and debt funding to VC-backed businesses from seed right through to IPO. I spend my time talking to founders and clients and VCs that are across the fintech space that are always looking to try and kind of do innovative and disruptive things across our ecosystem and grow their business. And we chat to them about their growth journey and how we can help in a variety of ways.
Amazing. Thank you. And in your opinion, who's going to win Wimbledon?
Wimbledon wins Wimbledon.
Excellent.
Last week was a joy.
There you go. Next up, we have a FinTech Insider return for Jessica Kath, Partner, Financial Crime at Thistle Initiatives. Great to have you back on the show. Jess, what have you been up to since we last spoke?
Well, since we last spoke, the world of financial crime never sleeps, and that's one of the stories we're talking about today. But, we've been doing everything from sanctions, remediating customer files, on building onboarding journeys, you name it, and just generally solving a lot of financial crime problems, to be honest.
So you've had a quiet time of it, yeah?
Very quiet indeed.
Excellent. Well, thank you so much for joining us. And last but not least, we have a FinTech Insider debut for Sophie Condy, CEO of ShieldPay. Welcome to the show. Can you tell us a little bit more about ShieldPay and what you've been up to?
Yeah, of course. Hi, Laura. Thanks for having me. Really excited to be part of it. So, I'm Sophie Condy. I'm 20 years in financial services and a self-professed payment nerd. And I've been enjoying getting deeper into all of these things. So ShieldPay is, we are a payment provider predominantly to the legal sector. And what we do is we are on a mission to be the most trusted payment provider to large, complex transactions. And as a self-professed payment geek, it's all close to my heart because it's all about moving money with the safety and soundness that it needs, and it can be quite complicated in how those things happen. We have 3 main pillars that we focus on, which is verification. So Jessica, very much similar to you on the financial crime side of things, we're very, very passionate about, and we work very hard to protect the money and protect people. We hold the money and then we can disperse that money through all of our payment rails. So what have we been up to most recently? Some of the most significant deals that we've been part of are things like different M&As or litigation payments. So we did a large data breach settlement in Austria. That was 153,000 claimants, and we paid that out in 48 hours. And some really large M&As as well across different jurisdictions, making sure that the money is all safe. And we're staying close to the SRA as well on their change in regulation for how law firms are managing their client money. So again, keeping us busy on that area.
Wow. Sounds very impressive what you've been working on, and we love a payments nerd on this show, so you're in good company. So let's start with the news. Our first story this week, HSBC Innovation Banking and Dealroom released their 2025 Q2 Innovation Update. The story, we picked it up in fintech finance, but also in many other places. Main findings were that UK AI startups raised $2.4 billion in H1 of 2025, accounting for a record 30% of all UK VC funding. In terms of innovation sectors, the health sector narrowly edged fintech to be the most funded innovation space, with both securing $2.3 billion. The UK continues to lead Europe in VC funding, ahead of Germany and France. And AI's share of UK VC funding has grown from 13% a decade ago to that 30% in 2025 that I mentioned. London led with 65% of AI rounds, but 57 deals happened outside the capital, showing UK-wide AI momentum, which is very exciting. And this comes as global fintech funding surges past $2.2 billion this week, with a massive deal for Propel Finance, who secured £1.5 billion in funding lines and facilities to expand SME asset lending capacity. So, Tom, of course, I'm going to come to you first on this one. Obviously, congratulations on another fantastic report. What are the kind of key highlights of this report, and how does that sort of differ from the previous quarter?
Yeah, no, thank you. It's really quite interesting. So to take a quick step back, we release these reports every quarter, and we have done for several years now. And it's a really good barometer of what we're seeing across the market, all very much data-led. So we allow the data to tell us the right sort of stories. And it wouldn't necessarily be a story at the moment if it wasn't AI-based story, you know? So it's been really interesting to see that kind of level of AI funding as a kind of across all the industries really begin to climb very, very quickly. And to get to that kind of 30% mark felt like a bit of a landmark. So, and seeing that actually kind of go from being very AI native businesses to being AI proliferated in all sorts of industries. So that's one of the things that's really come out as a highlight, is that it's kind of, we're seeing AI in healthcare, in finance, in softwares, in cyber, in consumer, B2C, etc. Something else that's really quite interesting, and you touched on this, Laura, is around the kind of how we're seeing this come out of London. I think sometimes in fintech, we can be a little bit of a London bubble, can't we? Like to be close to the city of London, like to be close to the big banks. But actually, when it comes to AI, it's something that can be done a little bit more as a thing in a garage or a bedroom or a WeWork in lots of different places all around the UK. And it's such an innovative and an interesting piece of technology that the universities are really beginning to kind of take something from it. And so some of that data that we're seeing around the proliferation outside of the UK, outside of London, is very much around kind of university spin-outs and really making sure that some of that innovation is being captured at an academic level and then being commercialized.
Thank you. Yeah, I think that kind of taking it out of London, the London bubble, is like such a huge step forward. Do you think, we would have seen that for anything other than AI? Is AI really driving this kind of proliferation of, a tool for kind of all industry, as you kind of mentioned? Yeah,
no, I think you're totally right. I think kind of that AI for all industries is really kind of why we're seeing this be so broad and so varied. I often think there's often pockets of kind of innovation in different sectors around the UK, whether it is the kind of life sciences bubble you see across kind of Cambridge, whether it is certain types of financial services you see coming out of Edinburgh, whether you see some of the manufacturing tech that you see sometimes coming out of places like Bristol and Birmingham. But actually AI now is being embedded into so many different types of industries. It's a great way for it to thread through everything. And so that's why we're starting to see that kind of trend of it being kind of pan-UK. And that, in my opinion, that can only be a good thing. I think the more we can see the kind of the UK economy as a whole be supported and grown through the innovation economy and through that lens, it's fantastic.
Absolutely. And then can you just touch on the sort of different sectors? So as we read in the beginning, healthcare just kind of tipped the scales slightly on fintech. What does that mean? What was kind of giving it the edge, do we think? Yeah,
there's been some bumper races around the kind of the life sciences and the health tech sector across the whole in the last quarter. But actually, that kind of narrative of fintech generally always being the most well-funded sector probably hasn't held for the last couple of quarters. In our Q1 report, fintech was third, narrowly behind some really bumper races for enterprise software. But fintech always being in that top three since the heady days of the 2021-2022 series of fundings continues to be that kind of major trend. there's a bit of an interesting skew to some of the data points that's showing that within fintech, that kind of the breadth of funding has very much been skewed towards the seed stage, earlier stage, which for me kind of starts to illustrate a little bit of a theme, I think, brewing around the next generation of fintech, and seeing some of those seed businesses start to become Series A businesses very, very soon, and then kind of grow from there. It does also imply a little bit of a narrative that kind of continued trend of the growth stage funding in the UK and Europe being a little bit of a harder zone, and that businesses kind of pivot to profitability a little bit earlier than they may have done in the US. But I think that's a different kind of conversation and a different narrative to try and fix.
Thank you. Sophie, coming to you as a fintech CEO yourself, obviously there's a lot to be positive in this report. Kind of as Tom says, like fintech doesn't always come out on top, but it's always definitely in the running. What's your take on that? Do you think there's a lot of positives to take from that kind of prevalence of fintech when it comes to VC funding?
Yeah, massively. Definitely. There's a huge amount of positive to be taken. And I think I was having a few discussions at a conference sort of a week or so ago, and it's fascinating because I think there's a bit of a reset going on. I think over the last couple of years, going from the real sort of growth and at any cost, doesn't matter, just grow, much more into that sustainability and scalability. And I for one, I don't know if it's just my makeup, but I'm all about that setting for scale from the outset and putting that governance structure in place to be able to set the businesses up for scale. And I think there's been a bit of a reset in the mentality around the investment for fintechs, which I think plays a really, really strong hand for us.
Definitely. And to that governance point and getting it right for scale, I mean, that'll be relevant to another one of the stories in the show today. But just kind of with that financial crime, that regulation hat on, that's obviously a good position to take if you're a new fintech kind of starting out and attracting investors, right?
It's not just a good position, it is a critical position. And a lot of firms think about, the more of the compliance financial crime element being a kind of blocker to growth, but actually it's a core enabler. And you won't get access to that funding if you don't have those control frameworks in place. The governance is not strong. There is absolutely no point. So you need to make sure those are in place. And it is a true enabler if you get that right. And of course, we are seeing, I think, a little bit of a tipping point at the moment with obviously the government's pushing a very big growth agenda and pushing the regulator to speed up its authorization process, for example, which will hopefully start opening up the doors a little bit more in the fintech sector. And hopefully we might see a few more coming through, getting over the line. So it's that combination, really.
Absolutely. And Tom, what's your thoughts on that kind of geopolitical piece? Like, as we said, the UK is kind of still outpacing the rest of Europe when it comes to this, but is there kind of more they can be done to sort of lean into that pace and sort of to stay ahead?
I definitely think so. And I think, when we think about why the UK is so dominant in Europe for fintech, kind of comes down to a number of things. It's kind of the importance of the City of London and what that means for an international kind of financial centre, access to talent, and not only the kind of British universities, but lots of young people wanting to come to a city like London to kind of grow their career at a younger stage. But also, and I think Jess has done this brilliantly, the regulator, and being able to kind of have a regulator that is trusted. A lot of people like to complain about the FCA, like to kind of say it's a bit slow, it's a bit clunky, but actually in comparison to some of the other regulators you see across Europe, it can actually be quite an innovative and forward-thinking kind of institution to work with, as evidenced by some of the things like the kind of sandbox regimes that they've had recently, and actually the more recent kind of AI sandbox being another iteration of that. And anything the government can do to kind of speed up those sorts of things. So eagerly waiting what comes out of the financial services competitiveness strategy that will be released, I think, next week, would be really interesting to try and see that we can kind of maintain some of those things that make us unique and make us stand ahead of the European peers quite a lot.
Yeah, I mean, we'll definitely have to keep an eye on that. See if that is as impactful as everyone hopes it will be. I just want to touch very quickly on that massive raise this week from Propel, 1.5 billion to kind of invest in the sort of infrastructure to support SMEs. Sophie, in your opinion, sort of how important is that to still see that, big ticket fundraisers can still be done even in the current climate, and particularly for that underserved SME support space?
It's just so energizing. It really, really is. And I think that we do need it in this space hugely. This is where it comes from. And I think actually, Tom, something you said, that seed round into Series A and all the funding journey that businesses go on, we start somewhere, but then you do need those injections and that appetite and the desire to invest and inject that capital to sustain growth and accelerate organizations. And we've been in such I want to say closed market, that it hasn't been closed. It's just been very uncertain and unknown what's going to happen. So seeing things like that, I think, is insanely strong. And yeah, I want to see more of that.
What was your take on that this week?
No, I think it's super interesting, and I think kind of one of the things to really kind of pull out of that is essentially that it's debt funding to be able to, excuse the pun, kind of give the fuel to propel that sort of business. And without that kind of debt funding, and this didn't, also another plug for kind of big banks, to come from big banks being able to use a tool or a business like Propel to be able to push those kind of that capital into the ecosystem is really, really important. Funding SMEs is really hard. It needs to be done. It needs to be done better and slicker and faster. Some of the decision making needs to be kind of more credible, more sensible, to give those kind of entrepreneurs who are starting a business more kind of support, and being able to find innovative businesses that can do that better than banks can. Brilliant. I think that's fantastic. But I always think you need to kind of keep in mind that it's SME funding is hard because starting a business is hard. When 20% of businesses fail in the first year and something like 60% fail in the first 3 years, there's a reason for that. And there's a reason why you need to make sure that the funding is right and kind of constructed in the right sort of way. And you are funding those sorts of credible businesses that will be part of that upper percentage that succeed.
Absolutely. And before we move on, just to give you the final word on your own report, what's the kind of final key takeaway that everyone should just sort of, if you had to summarize it, should learn from it?
Well, we're on a fintech podcast, so I think it's that fintech funding is still very buoyant. So we're always going to give ourselves any excuse to a little tap on our backs is very, very good. Mm-hmm. The theme of AI continues. So I think the more we can see around that, the more we can kind of talk and embrace AI across our industries and the businesses and even in our own individual lives.
Awesome. Thank you for that. And hopefully, by the time you do the Q3 report, we'll see how those trends continue.
We'll aim for a Christmas treat of the number one spot for Q4.
Yeah, there you go. You heard it here first. Right, I'm going to move us on to our next story, which is that the Santander bank deal could mean that the TSB name disappears from the UK high street. The story on Sky News is that Santander is rumoured to be acquiring TSB from Banco Sabadell for an initial £2.65 billion, potentially rising to £2.9 billion once it's finalised. Rumour has it that the bank plans to fully integrate TSB into its UK operations, which could mean retiring the TSB name. The merged group would serve nearly 28 million customers, becoming the third largest in the UK for personal account balances. And if approved by both Sabadell shareholders and the UK regulators, the acquisition could close as soon as Q1 2026. Jess, I want to come to you first on this, if I may. So TSB has had a bit of a turbulent few years. It's already changed hands twice in 12 years. It also had that kind of very well-documented kind of IT disaster, regulatory fines, a full recovery, and now potentially a sale. Are we surprised that Sabadell are selling them? Were you surprised that maybe Santander want to buy them? What was your take on this story?
So they have had a tricky few years. Last year they had the fine. I think it was 10.9 million, sort of, so almost 11 million over, treatment of customers in financial difficulty. And that was just one of the fines that were a long list of problems and challenges, the IT disaster also being one of them. So from my perspective, there are clearly some challenges there on the more operational side that will need a lot of kind of investment time to sort out. Being very careful with some of the wording here. So perhaps it's not necessarily a surprise, but I think we really need to think about the risks around the impact to customers as part of that sort of sale process, etc. I don't think it's a surprise, but it's going to need a lot of uplift to try and get it right.
Yeah, absolutely. And, we should say, as we did at the top, this is a rumor. It's not necessarily confirmed. However, usually these things are fairly confirmed by the time Sky News is reporting them. But, it's still not 100% confirmed. So the kind of merging of the brand names is not 100% locked in. However, sort of, Sophie, in your opinion, obviously, ChillPay is a digital platform. It's an increasingly digital world. But in terms of phasing out some of those branches, if they were to merge, the two brands together, what do you think the impact of that might be?
I think it's a really interesting one because I think we forget about, or we can forget, it's easy to forget about the end user. And exactly like Jess just said, for customers and people who are involved and personally impacted by things like this, it's huge, especially either elderly communities, vulnerable communities, people who prefer and require a more human touch or a base to be able to go and manage their personal banking needs, their mortgages, all of those things. I think it's really tricky. And I think we've all seen this happen personally over the last sort of 5 years. The reduction in branches has been huge for everybody. I think now, even if, when the auntie sends a check for the children, I have to go and do something with that to only scan it. But if I have to go into a bank, it's sort of on Google trying to find a branch somewhere. So I think it's tricky. I think if the kind of merger happens, if the brand's sort of absorbed, I think that consideration of impact to individuals is important. Albeit, I think that, I think digitization is huge. And I think even in the past, we were working on quite a big case, which had a very elderly population involved in it. And one of the cases that we were looking to try and solve for was how to get the money into the hands of these claimants, and made a very wild accusation that they would not absorb or be comfortable with having a digital payment of any sort. And actually, you start actually researching your customers and they much prefer it as well, because people do move with the times, and we've had digital payments for some time. So I just think, absorbing them and actually being pragmatic about it. We're running businesses with consumers and remembering the importance of it. But actually, I think, consolidating of branches is kind of, we need to expect it.
Yeah, I think it's not a surprise, but it might leave a few people stranded. I mean, as a very basic example, I was attempting to change my name after marriage with my bank. And the reason I haven't done it is because I can't find a branch that I can go to, around work to actually physically present myself and the right documentation and so on, because that's not something I can do digitally. You do need a bank branch for that. So yeah, it's just the removal of some of those like practical services you don't even know you need until you need them.
Well, people need to think about it, right? It's exactly that. And it's, like I was saying about checks, there was a problem with a check, and exactly you then have to look for a branch. And it's the banks being much more innovative in the solutions that they're providing, and name changes and, power of attorneys, all those different things. They need to have a digital offering as something to build on their roadmaps, I think.
Definitely, we should get you involved, get you to tell them that.
I'll just start pioneering it, it's fine.
Tom, in your opinion, do you think we're seeing a kind of wave of consolidation in the banking sector? Obviously, if these two merge, they're going to become the third largest, as we said, but also kind of, two become one, as it were. So you're losing a bank in that respect.
Yeah, I think,
is that a trend?
I'm unsure if it's a trend, but I do think it's interesting that there's going to be a kind of a change across the industry. The big four UK banks have been so dominant for decades. Those four brand names have always been so prominent. And so it'll definitely kind of show some sort of upset if now you've got kind of Santander coming in to be the third largest brand. I also think what's really interesting about that is it just really demonstrates Santander's commitment to the market and kind of really wanting to kind of go harder and grow and etc. So I think between that, I think it's kind of evidencing that there is a bit of change on the horizon for the kind of retail banking sector. I mean, it's probably a watch this space kind of environment.
Definitely. And I think it is interesting to your point that they're really doubling down on the UK market, obviously being a Spanish brand, where in their home market, they are kind of fending off hostile takeover bids from their rival BBVA and kind of, pushing them away with a stick sort of thing. But now they're doubling down on the UK. Jess, kind of in your opinion, what does that mean for the brand, and kind of what would the UK regulators be looking at when they come to approve or not approve, as the case may be, of this merger?
So the UK regulator is under so much pressure for multiple different things, and ensuring there's fair competition across the market is obviously something they're coming under pressure for. The UK market, we're still dominated by the handful of players, the big names, and this kind of merger will limit that name list even further. If it turns into a trend, Tom says it won't do, but if it does, I agree with Tom, actually. I don't think it will, but if it, for example, triggers any further consolidation, or they do see that the consolidation and loss of bank branches does actually impact customers negatively, and then from that consumer duty lens, you have a real issue, and reducing the kind of underserved communities, etc., that's when I think you're really going to see them push back even further on this kind of competition piece in future.
The Santander UK CEO claims that this will create more competition in the market, not less. Do you have a view, Jess, on how or why that might be? If we've, taken one bank out of circulation, how he's reaching that conclusion?
I disagree with it. I do not think this is going to end up with more competition. It's really looking at that consolidation.
That was my initial thought when I read it, but here's his quote, so I wanted to interrogate that. Sophie, what was your take on this one in terms of that competition piece?
Yeah, similar. I think knowing Santander over the years and knowing different colleagues there, I think that they're hungry and they have a strategy, and they do want to, I can feel they want to have that heavy presence and consolidate and take more over. So does it create more competition amongst the top four? Is maybe that the kind of theory behind the statement? It's kind of going, look, actually, we're here, we're a player, we're a sound player, we're really, really here, and we're going to stamp out our mark.
Yeah, we're coming for Barclays lunch, that kind of thing, rather than Monzo, maybe.
Exactly. And maybe there's just a new stance from them. I always find this stuff super interesting, because I think I love it even more so when people don't see it coming. Or, when you hear about it, you're like, oh yeah, okay, that kind of makes sense. So, I think it's an interesting one. And I think, the top four, like we've spoken about, they've been dominant for forevermore, right? And we're seeing the challenger banks just take different stances. I think the Monzo piece, again, is very interesting. I know we'll perhaps talk about it a bit later, but yeah, I think perhaps the statement is more about the top four and providing a bit more competition in there and really starting to stamp through some of that and demonstrate some change, whether that creates then a trend, whether it then creates those, it keeps it just moving, in my opinion, which is good.
Tom, would you concur?
Yeah, I think so. I think it's kind of a case of, maybe the kind of competition pieces around the big four become the big five, potentially. Is that going to be kind of, the angle you're going to get to this? But actually, at the end of the day, and you've got one fewer brands on the high street, that can't be a good thing.
Interesting. Yeah. So in terms of phasing out that kind of brand name, Jess, in your opinion, does that have a sort of reputational change? Say you're a TSB customer, suddenly you become a Santander customer. Does that have a knock-on effect? Do people care, or could that actually force people to switch?
I don't think it has as much of an impact now as it used to. Obviously, there are some customers in the market that do have that kind of loyalty to the brand for a very long period of time, but a lot of the younger generation are more than happy to cross across different brands, and they're looking for speed, they're looking for good customer experience, they're looking for access to a variety of services in one platform, not necessarily the brand or the name. But again, each customer has very, very different requirements for their banking and digital services. I don't think it's necessarily the name anymore.
Well, yeah, I think that will be interesting to keep an eye on, because, maybe it's not just the name, but it is those services. It is kind of taking away some of those branches. Or I don't know enough about the individual brands, but if one offers something that the other doesn't, do they merge them, or are they actually taking services away? We will have to keep an eye on that one and see. As we said at the top, we might be waiting for Q1 next year to confirm whether this happens. So we'll obviously have to keep an eye on the rumour mill to see if it does. But yeah, lots to unpack when it does, and equally, just the practicalities of merging two enormous banks will be an interesting challenge when it happens. On that note, we're just going to take a quick pause here. Back very shortly.
Close your eyes, exhale, feel your body relax, and let go of whatever you're carrying today.
Well, I'm letting go of the worry that I wouldn't get my new contacts in time for this class. I got them delivered free from 1-800-CONTACTS. Oh my gosh, they're so fast.
And breathe.
Oh, sorry. I almost couldn't breathe when I saw the discount they gave me on my first order. Oh, sorry. Namaste.
Visit 1-800-CONTACTS.com today to save on your first order.
1-800-CONTACTS.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's vanta.com/insider.
Welcome back. Before we dive back into the news, we want to share our latest Insights episode with you. As we know, financial services are evolving rapidly. Where innovation and customer experience once led the agenda, banks are now focused on stability and securing business-critical operations amid market uncertainty. So, what does this shift mean for advice and consulting? Because we don't just do podcasts here at 11FS, we also do consulting, and we won Consultancy of the Year at the British Bank Awards, no less. So, David Barton Grimley put the question of navigating change and supporting clients to Ross Gallagher, who heads up all things consulting here at 11FS, as well as industry expert Kate Drew, Director of Research at CCG Catalyst Consulting Group. To find out more, the episode is out now. Just head to the podcast below this one. Okay, back to the news, and our next story is that Robinhood are confident that tokenized equities will withstand regulatory scrutiny. The story in payments. Robinhood has begun offering tokenized US stocks and ETFs to European users via its new platform built on the Arbitrum blockchain. Trades are 24 for 5, not 24/7, commission-free and settled via blockchain tokens. Revolut is offering access to token-like assets representing private companies like OpenAI and SpaceX. These are not real shares, just synthetic representations. OpenAI has publicly clarified this to avoid confusion. The Bank of Lithuania, Robinhood's EU regulator, has requested more details on how these tokens are structured and marketed. Robinhood CEO Vlad Tenev said the company is confident its products can withstand the highest form of scrutiny. So, we were talking before the show. This is a fairly complicated topic. Tom, could you sort of break it down for us a little bit? What does sort of offering a tokenized US stock or ETF actually mean?
So trying to take that kind of very, very high level and simplistically, essentially what you're trying to do is rather than acquiring an asset, a share, a bond, an ETF, through a standard exchange, which will have a fair price, which you can see on the market and is traded in a regulated way. You're taking that into a separate market that will essentially mirror it in a digital fashion, whereby you're buying a token that will hopefully match the asset, but won't be backed by the asset, that can be traded in much the same way. And so the idea being that the kind of underlying valuation of it could still be the same, but because you're trading it in a digital fashion, you're holding a digital token on a blockchain, you can do that cheaper, faster, more conveniently. You can also do it in a fractionalized fashion. So if a share price is, £1,000, you can buy a small slug of that rather than having to fork out for the full £1,000 share. And being able to do that kind of helps to kind of take away some of the friction you see out of trading, and be able to kind of broaden out how access to those types of assets can be proliferated.
Amazing. Thank you for that. That really helps kind of make it real for everyone. So that's what Robinhood are trying to do. But then equally, they've added in this kind of synthetic representation of a share. Sophie, kind of what's your take on that? It's kind of a tokenized version of a private company stock, which actually isn't public market knowledge, as we were talking about off air. And OpenAI have kind of come out and declared that this is not kind of a real share, and they are very keen to make that clear to everyone. What's kind of the impact of that in terms of making shares of companies that aren't necessarily publicly traded yet?
Yeah, it's such an interesting one, and I know we were discussing it a little bit more together because again, it's just so complex. I think one of those things where it becomes, when you make things like this public knowledge, when that's not what they're designed to be, and again, does that impair on or infringe on things like competition or insider trading and those sorts of concepts? I guess everybody's going in with their eyes wide open, and I think that, as I was saying earlier, we've explored stablecoins and asset tokenization before with some of our partners, and it's something I'm super interested in. And I think there is something in this very similar to when crypto started, and then I sort of was again, I'm incredibly interested in the concepts behind it, the blockchain, the auditability, the efficiencies, the securities, providing it's all governed correctly, treated in the manner that it should be treated, and how the technology can enable these types of things across the globe in multiple environments that may not have had access to things like this. So I know that's not answering your question in the regards of what does it really mean when you're going to be sharing sort of private knowledge publicly and start making those sorts of things available. I think there's two sides to it, and that's not me sitting on the fence being unopinionated, because that's not me. It's more that I think there are two sides to it. I think it could be positive. It could encourage and add some insight and energy into how we could make this work. And on the flip side, I think it could be damaging. So I think it's just around how we learn from what we've done already with technology in this space, how we start to put some processes around that, how we can embed some governance and some support without getting in our own way and overcomplicating things, and how you can then land it in the market.
Thank you. And just kind of on that governance piece, as we said, the Robinhood CEO is very confident that this will withstand the highest form of scrutiny. What are the Bank of Lithuania on the European side, the SEC, kind of thinking when they are scrutinizing these things? What sort of thing are they kind of looking for?
Yeah, so a lot of them are basically applying the same it's the same activity. It's got the same risks in many ways. I mean, Sophie just touched on things like market manipulation, and therefore it's being increasingly clear that they are aligning the same core principles here to traditional securities. So even though they are kind of a tokenized digital representation, they are going to still be subject to the same regulatory frameworks, but there are still a lot of nuances, and regulatory boundaries are still not very clear across multiple different areas, which makes it tricky for both the firms trying to launch these products, but also customers trying to engage with them. I did read today that a couple of days ago, the crypto mom, they call her in the States, the US securities regulator, Commissioner Hester Pierce, she basically said that they remain securities and must comply fully with all of the federal securities laws. So registration, enforcement obligations, disclosures, everything will be the same, because ultimately the risk profile here is very similar. So you've got the market manipulation risk, custody failures, you've got disclosure issues. Of course, from my perspective, you've got all the requirements around AML, KYC. All of these are absolutely critical. But on top of that, you've got some really nuanced risks specific to these product sets, which a lot of people still haven't kind of grappled with, which is a lot of customers are not understanding that this is not a security. This is a digital representation. And it's just making sure that customers that are engaging with this, I mean, for example, Robinhood's traditional customer base is the retail investor, not institutional investors. I don't know, but do they have the full understanding of what this is in order to engage with it fully? So there's many different things that we kind of have to unpack and unwrap to make sure that customers are engaging this in a sensible way, and regulators can build the appropriate framework around it to make sure that we are minimizing those risks and mitigating them.
And one thing I'd add to that, Jesse, I think to really kind of double down on bits is around the security point of this. When you buy a share, you know that it's on a register somewhere and you've got that kind of credibility to it. If you're buying a digital representation of something, there's a good chance that that could, in theory, be stolen. That could be copied, mocked, etc. And so being able to have the safety and security of knowing that you've got that asset, you can kind of retain it in a wallet, and sometimes having kind of like a really credible exchange to have that in is helpful, but it still is a slightly more unknown, less secure an avenue than if you were going to go and buy that original asset in the first place. Brief little plug, HSBC in Hong Kong developed a similar platform for fractionalized gold, and the level of quantum cryptography that needed to be required to be able to kind of make sure that those tokenized assets were secure is mind-blowing, the type of level of security that has to go around that in order to give the customers that kind of confidence. And that's exactly what you need. And I think it's really great that the regulator's saying these will be treated like any other asset, but you still need to have all of the wrap around it, around security.
Yeah, definitely. And sort of to Jess's point, like the trickle-down effect on customers actually understanding what they're getting into as well. Like, there, is it Robinhood's responsibility to educate the user? Is it the user's responsibility to educate themselves? Is kind of a perennial question, but it is definitely one worth asking when they're kind of changing the way the system works. If you're creating sort of synthesized representations of shares, that's entirely new territory, right?
Yeah, totally. And I think if you're going to have a crystal ball moment and kind of fast forward time by 10 years, actually, Robinhood are pioneering something here, and as similar to other exchanges have all been doing in a similar sort of fashion to kind of push this forward. But actually, what you'll end up seeing is that all the exchanges that run these types of securities anyway will just merge into this type of technology. So all the benefits you'll see around 24/7 trading and kind of cheaper commission cost, etc., will just naturally gravitate into what is the kind of today's BAU in a digital fashion, in my opinion.
Do you think as well on that, because I think this is something I find really fascinating, that there's this kind of big bang approach to things, and it's actually more, the more we can test and learn is so much more powerful, because actually getting your head around things like this, and as we were saying before the show, this is such a huge concept to get your head around, especially if you're even in the industry. We all touched on the pieces that we'd spoken about, where you'll start trying to consider how things are converted, where the responsibilities, where's the liabilities, all of those different things. And we're talking about an end-to-end here that's just so out there at the moment, that actually the gentle steps to get there, you're absolutely right. I think if you fast forward, we'll be there and it will make sense to us, and we have to take those steps to get there. And you just want to, like we said earlier, set this up with scale and sustainability and governance in mind. So you start with that clarity: what we're trying to do, why we're trying to do it, what does that mean, then the controls and the governance and compliance. I know it's not nearly as exciting as that big bang release though, but I do think that there's those stepping stones to get us where we need to get to, and then bringing along your audience is so important.
Definitely. I think that is completely it. It's sort of, you've got to bring people with you, otherwise you'll only get in trouble if people don't understand what it is that they're doing, and rules are broken and so on and so forth, which is actually going to bring us nicely onto our next story, which is that Monzo has been hit with a £21 million fine for anti-money laundering failings. Story in Finextra. The UK's Financial Conduct Authority has imposed a £21.09 million penalty on Monzo for inadequate anti-money laundering and financial crime controls between October 2018 and August 2020. Monzo's user base grew nearly tenfold in this period, but its internal systems didn't scale to match this growth. The FCA found serious deficiencies in Monzo's onboarding, customer risk assessments, and transaction monitoring systems, including signing up over 34,000 high-risk customers, some with implausible addresses such as 10 Downing Street, Buckingham Palace, and some put Monzo's own headquarters. This action follows a similar £29 million fine against Starling Bank for weak AML controls in October last year, highlighting a broader regulatory crackdown. So Jess, I'm going to come to you first, largely because you were on that show when we talked about Starling, and of course this is very much in your wheelhouse. Kind of, how did the FCA get to this conclusion, and how does this happen? How do Monzo onboard 34,000 high-risk accounts with ridiculous addresses and things like that attached?
I mean, it's a pretty damning read, but it's actually easier than you think to make these kinds of mistakes. And if we look back at the Starling Bank fine, there are just so many similarities. I mean, with the Starling Bank fine, of course, that was focused more on weaknesses in sanctions screening tools and data sets. Ultimately, this one is more focused on the customer due diligence side with the classic 10 Downing Street, for example, and the addresses. But ultimately, if you don't have a holistic control framework that's operating with the right questions being asked, the right tool sets and the right data, collecting and verifying the right piece of information, ultimately, you don't know who your customers are. And I think that's one of the key things that came out here is that as part of their growth journey, they really thought that they just had UK resident retail customers doing lovely things on their platform. And that's part of that kind of great fintech story. But ultimately, there were customers on there that were trying to do things that were not quite so nice. And that's where you have, the fraudulent use of addresses and just not collecting that information at onboarding meant that their ongoing monitoring was also very difficult to implement because they weren't collecting the right information, weren't verifying the right information at the start of the process, and therefore they couldn't monitor effectively. I mean, there were so many interesting things in there, like the transaction monitoring piece, like the CIFAS database for fraud checks as well. And to Sophie's point, there are a lot of pieces around governance and culture. We've picked on governance a lot today, but ultimately it just meant that their holistic financial crime framework wasn't collecting the right information or answering the right questions. And ultimately that meant that when they had their voluntary requirement or not so voluntary requirement put on them, they could not adhere to it. And a very high number of customers snuck through as high risk when they could not monitor that and they could not verify that they're actually meeting those requirements, which ultimately meant that they got a slightly higher fine, although it was reduced for certain reasons because of their good remediation program. But it was just a multiple failures across the framework.
Mm-hmm. But I mean, as we sort of said at the beginning, not that it's excusable at all, but it is important to note that this is from the period October 2018 to August 2020, meaning that it's not necessarily representative of Monzo as it is right now, but how it was back in the day when, as you said, it was sort of scaling en masse and trying to onboard as many customers as possible, and these things were not adhered to. Sophie, what does that mean for the sort of the consequences of that on the brand? Because I'm stressing that this is Monzo back in the day, but do people reading that headline and not reading anything else take that on board, or do they, is that a reputational damage of how they think Monzo conducts themselves right now?
Yeah, I think it could be, because people don't necessarily read the detail, do they? They'll see Monzo's been fined by the FCA for failings in financial crime, and I think it could definitely be damaging to the brand. To counter that, I think there's so many fines and there's so many failings of scaling businesses and banks in general and financial services. I think one of the hardest things for businesses to do is they scale, and exactly like we just said, this was from October 2018 to 2020, and then like we know, that's when Monzo really kind of took off and were really focused on growth and scaling. Their risk-based approach to their monitoring, their controls, what were they doing? How were they doing that as a business, and a young business at that? I think is incredibly tough to navigate for businesses. And again, I do feel like a broken record, and I am sorry, but it does come back to that. When you start these businesses up, and when you can have the right advisors and VCs or governance people supporting you to say, look, you know what you know. You don't know what you don't know. And this is where you bring in the right support and consultants and other people to go, you need to think about these things. And as you scale and grow, you're going to need to take a different approach to how you are monitoring your transaction, monitoring your KYC, your KYB, or all of your CDD. And you have to be alive to that all the time and thinking about it. So I think it could be damaging for their brand. I hope it's not. I am a big fan of Monzo. I think what they've done is really, really remarkable. And I like how they service their customers and how they think of their customers. So I imagine for them, this has been quite damaging for their own culture and quite painful, because I think they're very proud of what they've done. And yeah, I think this is a good recognition that you can't behave like that, and you know there is consequence if you don't stay ahead of the game here. And it's not even ahead of the game, is it? It's complying with what we're all needing to do when we're a licensed institution. And so it's important that there's reprimands. Yeah,
it is the game.
Yeah, exactly that. Yeah. So I think it could be damaging.
I like the term consequences you use there, Sophie, because I think some of these fines are also quite important from an industry perspective, because it keeps everybody's kind of eye on the same situation. Earlier, we spoke about kind of like the shift towards sustainable growth and not having that mindset of growth at all costs, and then you backfill all the bits and pieces anyway. And that's not to insinuate that that's what Monzo did back in those days, but it was very much kind of the heady days of the Monzo kind of really like scaling very fast. And so to have that kind of culture and mindset shift through our entire fintech industry is probably very, very good. And to actually kind of start to have that philosophy of you want to have growth, but you want to have growth that kind of goes at a kind of sustainable way that means that you're kind of doing the right thing, not only for your own business, but for your customers and for how you're building all those blocks.
And it's very hard.
And as you say, like the right thing at the right time, not after the fact.
Yeah.
It's very hard to do, especially in the industry. I think, I come from a scaling business, and we're absolutely shifting from, like we said, that hunger for growth at all costs right through to now turning into a profitable enterprise. And it has to be, and we are so firm with this as a business, and me as a CEO and a leader of ShieldPay, it's not revenue at all costs. We will only do the right thing, and we use our regulation and our all of the rules and regs, all of our governance as enablement, and we won't do it. But it's very hard for the industry, and when you're constantly under pressure to deliver and execute and so on, and with investors, with board members and VCs all pushing you to get to where you need to get to, it can be very challenging. But you have to have that ingrained in your culture and your belief. You have to. Because consequence should be served if you don't.
And to your earlier point that there are lots of other fines, and to Tom's around keeping the kind of industry on its toes. We talked about Starling's £29 million fine. The FCA gave out 176 million in fines across 2024. But we should say this is not just a neobank problem, right? Just like in 2021, NatWest was hit with a whopping 264.8 million fine for ignoring red flags, fairly obvious ones such as bin bags stuffed with cash and things like that between the period of 2012 and 2016. So everybody needs to adhere to these rules. This is not about singling out neobanks or, against anyone else. And to be fair, the scale of the fine obviously gets bigger the bigger you are, right?
Yeah, I mean, for people that work in financial crime day in, day out, we've known for a long time that this has been a big focus of the regulator. I mean, it keeps us unbelievably busy all the time. But we already know this going forward, because set out in their next 5-year strategy, financial crime is one of the 4 core pillars of that strategy. We know that creating an environment where people can engage with products and services in a safe way and mitigating financial crime is an absolute focus of the regulator. So we're not going to see them back off from these kind of fines. I mean, we've also seen a big spike in the use of Section 166 skilled person reviews as well, which are, again, very intensive, but they're a lot of money, and they come in and have a look at your entire framework. And we are seeing a lot of those being used, and you can see a very big spike on those. They either come in and look at your entire framework, or they come in and the FCA is doing specific focuses on specific control areas at the moment. So we know that the regulatory push at the moment is looking at sanctions. It's looking at trade-based sanctions. It's also looking at market manipulation. Those are its key focuses at the moment. And we can really see that each of these different core financial crime areas are being truly targeted by the FCA. And it's all part of this smart regulator push. So we've got the new RepCrim financial crime reports, and they are analysing all of the data across multiple sectors, looking for key issues and trends across specific sectors and targeting those sectors with that issue. And that's where we're seeing specific sectors over specific issues, and we will continue to see that at least over the next 5 years, because it very, very much is a continued focus.
Absolutely. So we will continue to see headlines like this coming to the fore, do you think?
We will indeed. We will indeed, yeah. And one of the things that, a lot of the things that firms always forget is, yes, this is costly. It's damaging on their reputation. It's damaging potentially from a customer perspective as well. But the one main problem that people always overlook is the morale impact it has on the business whilst you're dealing with a skilled person, whilst you're dealing with a large multiple-year remediation program. It's the constant pressure and the low morale. That's the real thing that businesses struggle with across these challenges.
That's such an interesting point that doesn't really get much airtime. So yeah, thank you so much for kind of adding that spin to it right at the end. However, I know we could probably talk for ages on this one, but I am going to move us on. Okay, now for a quick look at one more newsworthy story this week that we don't have time to cover in full, but we think you will find just as interesting. This story in fintech finance news. A new report finds that Gen X prioritizes security over convenience in payment choices. According to the report, when it comes to choosing how they pay, Gen X, that's people aged 45 to 60, put security at the top of their list. Nearly half of them reach for their debit cards, with credit cards coming in second at 33% and good old-fashioned cash is still hanging on at 22%. Many of them don't use digital wallets like Apple Pay or Google Pay, which came in at around 5 to 6% of use. And according to this study, the group's main concerns are fraud risk, closely followed by hidden fees, with only 31% valuing loyalty programs, closely followed by cashback offers. So I have to say, I don't think this is particularly surprising. Thinking of my mum's generation, who's perhaps slightly older than Gen X, actually, just to out her a little bit there, but around the sort of 60 mark, I don't find that surprising. I think, we see this a lot of sort of reluctance to embrace new technologies such as an Apple Pay or Google Pay, almost because it's too easy and they don't trust what's going on under the hood, preferring, to stick with what they know. Adapting even to contactless debit cards or upgrading from an Oyster card to contactless on the tube, seemed a step too far a few years ago. So I think this isn't really surprising, but I do think change will come. It will just come a little bit slower to maybe millennials or Gen Z. I'm not really surprised that the main concerns are sort of security, fraud risk, that sort of thing. What's interesting, I think, is surely that is everyone's concern. If you break that down by all the other age brackets, that's probably everyone's concern. However, perhaps the younger generations are more likely to trust the newer technology to fight that fraud risk, more so than a sort of debit card and credit card. And we're increasingly seeing that Gen Z in particular are turning their back on credit cards. Perhaps they're a little bit more embracing of buy now, pay later, and whether or that should be categorized as a type of credit is a discussion for another podcast. But I think these findings are not that surprising. The report does go on to say that Gen X values substance over style, and that payments providers should think about that when designing kind of new flashy experiences. But I think probably finding the balance between the style and the substance is probably where you're going to please all crowds. Okay, I'm going to move us to our and finally story now. So, as it was London Pride this week, we thought we'd take a closer look at this story, which is that the Payments Association calls for more LGBTQIA plus diversity in payments. So the Payments Association is calling for more meaningful inclusion in the UK payments industry, warning that many companies engage in sort of surface level support, kind of the classic sort of rainbow branding during Pride and so on, without any real lasting change. And the call to action follows their association's 2025 D&I survey, which revealed considerable gaps in how the sector collects and uses diversity data when shaping its policies. And they have said that inclusive product design is needed. Platforms should respect users' pronouns, chosen names, and diverse identities with better internal policies and active leadership to promote inclusion. I mean, that sounds like a fairly obvious thing, but it's obviously lacking in the industry for them to have kind of made this stance. What's your initial take on this? Who would like to start?
For me, this is kind of a data story, which I think is really interesting. That kind of something as interesting as pride and kind of the sexual orientation kind of lens of diversity, I think is super, super important. But it's about making sure that if you're capturing that data, you're going to understand your customers better. You'll understand the kind of how people are using and interacting with your products. And if they're not interacting with your product in the way that you would expect, it's then around the kind of piece around adapting and kind of being able to do things with however the payment profile is to be able to better account for that. I think financial inclusion is such an important part of the financial services industry. And I think there's so much opportunity within the world of fintech to put new technology into that if you can kind of capture the right data and understand the customer journey for some of your underserved customer groups, then there's probably a lot of interesting commercial angles that you can kind of come at for this. And so I always sometimes feel if you put a kind of a revenue carrot over a problem, someone will go ahead and solve it.
Definitely. I think the report said something like only 11% of companies are actually, trying to find out this information on their customers, meaning, to your point, that they're leaving a huge amount of data untapped on the table.
And you use the example there around the pronouns. If you're a customer for whom that's a really important part of your identity, they won't forget that you've kind of taken the trouble to build your product. Maybe it's the UX of your app or something like that will kind of get that right. You've got a loyal customer and probably a brand advocate, and they're invaluable.
Definitely. And equally the other way around too. Like if you disrespect people's pronouns and force them into sort of, the wrong boxes, so to speak, when they sign up and that sort of thing, like that is going to have a massive negative impact on their interaction with your brand. And of course, they will remember that and act accordingly. Sophie, what was your take?
I think Tom's absolutely nailed it. I think one of the challenges we face, though, is how data is used. And again, the protection of data. And I think there's a real adversity to completing some data fields due to perhaps perception that it's going to be used in a negative way. So I think you're right. I think it's not mandating it, right? It's making it available. It's making it available and capturing data and making sure that your product is fit for purpose for all of your consumers and ensuring that is used in the right way. I think my only concern with exactly what you said, Tom, is how that data is then used and then how it's going forwards. But yeah, I think it's fantastic. And I think we absolutely need to make our world incredible, like everywhere inclusive. It doesn't matter. And I say that hand on heart. And it doesn't matter any of your orientation. Other than you should feel supported and should feel included and you should feel part of your environment, our environment where we are. So yeah, I think data is the most important thing. I think the commercial elements will really drive businesses to do this. It's wonderful to hear more and more about it, especially with the, I don't know that we'll get through the whole podcast without talking about Trump, but maybe we should. But, with everything in the US, around this, I think it's wonderful to hear that we're getting it front and center and it's getting more attention again on a positive way, in my opinion.
Definitely. Jazz?
From a financial crime perspective, we really need to think more about diversity and inclusion when building financial crime products. So if you take, for example, your onboarding journey with identity verification and you have someone that's transitioning genders, you really have to think about, do you have a process in place to facilitate kind of manual onboarding or an additional or something that will solve the problem of dealing with different faces with traditional ID and V vendors. So that's some of the things that we're working with at the moment. And we have to think across a lot of different types of diversity and inclusion when we're building these frameworks, because ultimately our frameworks should be preventing financial crime, not preventing genuine access to services to people that absolutely should be part of these services with no problems whatsoever.
Absolutely. But yeah, I think, it's obviously a timely call out from the Payments Association. I think, it's pretty cool that they were heavily involved in London Pride, as was Monzo. They had a whole sort of part. They were part of the parade, which I think is very cool. I don't know if they're the first fintech to do it, but they're, talking about the top 4 banks, it's not really the space that they play in. So I think, that's it's very cool to kind of see the industry starting to get behind these initiatives. Obviously, what they the actions will be more impactful on their customers than anything kind of performative, but it is, indicative that this is something that is on the agendas of some of these companies.
Yeah, definitely. And I think part of that is that kind of pink washing agenda that might kind of come out of a lot of these things. It can be one thing to put a load of pride flags over your logo, or to even be part of the kind of the celebration that is Pride on the day. But if your products and services don't reflect those types of customers,
yes,
it does feel a bit disingenuous, doesn't it? So it's around getting that balance completely right, and some brands do it fantastically well.
Absolutely. And yeah, much to take forward from Pride into the rest of the year for, to make those kind of diverse, financially inclusive products, I think. But on that note, that wraps up today's FinTech Insider News. Thank you so much to today's guests. Where can people find out a little bit more about yourself and your companies? Let's start with you, Tom.
You can find me on LinkedIn. I'm a Thomas on LinkedIn, so that's Thomas Easterby. Very formal. My mum will be proud. And you can find more about HSBC Innovation Banking at hsbcinnovationbanking.com.
Fantastic. Thank you. Jess?
It's Jessica Kapp, again, the full Jessica, very formal, on LinkedIn or thistleInitiatives.co.uk.
Brilliant. Thank you. Sophie?
Yep, I'm also Sophie. I guess there shouldn't be a Sophie Condy, but yeah, Sophie Condy, also on LinkedIn. And you can find us, and you can find ShieldPay on LinkedIn and shieldpay.co.uk.
Thank you so much. As for me, you can find me, Laura Watkins, full name, on LinkedIn, otherwise on 11fs.com or search for FinTech Insider. Thank you so much for listening to today's FinTech Insider. If you like what you've heard, please do make sure to follow us on your favorite podcast platform of choice. And if you really love the podcast, why not share it around? Share it with a colleague, share it with a friend, share it on your LinkedIn. As always, if you want to join the conversation, please find us on social media. Just search for 11FS or FinTech Insider. Odds on we'll be there. Or email podcast@11fs.com. Thanks again, and goodbye.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's VANTA.com/insider.